This isn't some minor slowdown in shopping. What we're witnessing is a sweeping collapse spreading across the American retail landscape. Companies that once looked untouchable are bleeding cash, closing thousands of storefronts, and quietly preparing for possible bankruptcy filings. Shoppers are carrying more than $1.2 trillion in credit card balances. Mall visits remain roughly 30% below what they were before 2020. Even discount chains are feeling the strain as rent climbs, shoplifting increases, and interest rates push borrowing costs sharply higher, all at the same time. This isn't random chatter or empty speculation. It's a countdown already in motion. These aren't small, forgettable brands, they're household names, and by 2026, many of them may no longer exist. Number 15. Foot Locker. On the surface, Foot Locker appears stable. The stores are open, the sneakers are on display, and the brand still carries recognition. But beneath that surface, the financial story tells something far more troubling. Over the last few years, the company announced plans to close more than 400 locations, mostly inside traditional shopping malls. Industry analysts now warn that the total number of closures could surpass 600 by 2026 if revenue continues trending downward. The core issue is straightforward. Mall culture is fading, and sneaker buying habits have migrated online. Major brands like Nike and Adidas have aggressively expanded their direct-to-consumer strategies, selling through their own websites and apps. That shift removes the need for a middleman, and Foot Locker has long depended on being exactly that. The numbers highlight the pressure. Revenue peaked at approximately $8.8 billion in 2022. By 2024, that figure had slipped below $7.6 billion. Profit margins, once above 6%, have collapsed to under 2%. In retail, that kind of compression is severe. Meanwhile, fixed expenses aren't easing. Rent obligations remain high, wages continue rising, and inventory losses from theft, often called shrink, are increasing. Mall traffic across the country is still running about 25 to 30% beneath pre-pandemic levels, limiting the potential for recovery. To fight back, Foot Locker has committed billions toward remodeling stores and launching high-profile flagship locations in major cities. The strategy aims to modernize the brand and create destination-style experiences. But timing is critical. Those upgrades demand heavy capital investment at a moment when interest rates hover between 5% and 6%, making debt significantly more expensive than it was just a few years ago. If consumer spending weakens even modestly in 2026, the company's already thin margins and smaller store footprint could deteriorate rapidly. This is no longer a growth story. It's a company steadily retrenching, one step at a time. Number 14. Carter's. Carter's operates in a category that seems recession-resistant: children's clothing. Families will always need clothes for babies and toddlers. Yet even that essential demand hasn't insulated the company from mounting financial strain. The underlying challenge begins with demographics. Birth rates in the United States have fallen to around 1.62 births per woman, the lowest recorded level in modern history. Fewer births today mean fewer toddlers tomorrow, and ultimately fewer repeat purchases in the very segment Carter's depends on. This isn't a temporary dip that rebounds next quarter. It's a structural demographic decline. Financial performance reflects that reality. Revenue reached nearly $3.9 billion in 2021 but slipped to roughly $3.3 billion by 2024. Operating margins, once comfortably in the double digits, have narrowed to about 6%. At the same time, input costs have surged. Cotton prices remain more than 40% higher than pre-2020 levels. Labor expenses have risen, and shipping costs have not fully normalized. On top of that, parents are adjusting how they spend, turning to resale apps, discount platforms, and second-hand marketplaces to stretch household budgets further. For Carter's, the challenge isn't simply competition. It's a shrinking customer base, higher operating expenses, and more price-sensitive shoppers, all converging at once. Rather than spending extra on recognizable labels, a growing number of parents are opting for lower-priced bundles and private label deals from places like Amazon, Walmart, and Shine. The shift isn't subtle. It reflects a broader change in household priorities as families search for value wherever they can find it. Carter's has reacted by closing dozens of weaker-performing stores and cautioning investors that demand remains soft. But trimming locations is only a surface-level fix. The larger challenge is structural. When a shrinking customer base meets stubbornly high operating expenses, profitability gets squeezed for years, not quarters. The company is also carrying over $1 billion in long-term obligations. Refinancing that debt in today's environment, where interest rates range from 6% to 7% instead of the ultra-low 3% era, puts significant pressure on cash flow. Higher borrowing costs eat into flexibility at exactly the wrong time. If consumer spending slows even slightly in 2026, Carter's could find itself shifting from cautious cost-cutting to aggressive restructuring far faster than many expect. Number 13. Dollar Tree. For years, Dollar Tree was viewed as a safe haven during economic downturns. When everything else became too expensive, shoppers flocked there. Ironically, the company now finds itself under the same strain hitting the broader retail world. Its identity was built around one simple promise: everything for $1. That clarity disappeared when management raised the base price to $1.25, a 25% increase overnight. Customers felt the difference immediately. The psychological appeal of the "everything's a dollar" concept had been a powerful draw. And once it vanished, traffic began to cool. Revenue still appears strong on paper, exceeding $30 billion annually. But headline sales figures don't tell the whole story. Operating margins have fallen below 5%, down sharply from nearly 12% before the pandemic. That kind of decline signals deeper stress beneath the surface. Theft-related losses, known as shrink, are now costing the company more than $1.2 billion per year. At the same time, executives have acknowledged that a substantial number of stores are barely profitable. If profitable at all, then there's the lingering impact of the $9 billion Family Dollar acquisition. Instead of fueling growth, it has become a drag on performance, forcing hundreds of closures and weighing on overall results. Debt adds another layer of vulnerability. Dollar Tree is responsible for more than $10 billion in total borrowings. Servicing that debt at today's elevated interest rates drains cash just as its core customers, primarily lower-income households, are running out of financial breathing room. Many of those shoppers are already maxed out on credit cards and cutting back on even small discretionary purchases. When your customer base is financially strained and your cost structure keeps climbing, the margin for error disappears quickly. Dollar Tree no longer represents a defensive growth play. It increasingly resembles a highly leveraged operation trapped by its own rising expenses. Number 12. JCPenney. JCPenney stands as a classic example of a retailer that survived, technically, but never truly recovered. The company filed for bankruptcy in 2020, wiping out shareholders and eliminating thousands of positions. What followed wasn't a dramatic turnaround story. Instead, it has been a gradual, fragile continuation supported by private equity ownership and tight financial maneuvering. The store count alone illustrates the contraction. In 2012, JCPenney operated more than 1.100 locations nationwide. Today, that footprint has shrunk to around 650 stores, with additional closures already planned. Revenue trends are even more sobering. A decade ago, annual sales exceeded $17 billion. By 2024, the company struggled to hold on to roughly $7 billion, less than half its former peak. One of the heaviest burdens weighing on the business is its real estate exposure. JCPenney remains tied to billions of dollars in lease commitments and long-term obligations connected to aging shopping malls. Unfortunately, those malls continue to lose relevance. Foot traffic across U.S. malls still sits roughly 25% to 35% below pre-pandemic levels, limiting the retailer's ability to drive consistent in-store sales. The brand may still exist, but the foundation it once relied upon has eroded, leaving it in a precarious and uncertain position moving forward. Former department store anchors like JCPenney used to be magnets that pulled shoppers into malls. Now, instead of driving traffic, they often highlight just how empty those spaces have become. The chain's core shoppers are aging. Younger consumers rarely feel connected to the brand, and its in-house apparel lines face non-stop pricing pressure from Walmart, Amazon, and ultra-low-cost fast fashion giants. With borrowing costs still high and refinancing opportunities becoming more limited, JCPenney has almost no financial cushion left. If the broader economy contracts in 2026, the outcome likely won't be described as another failed comeback attempt. It will look more like an inevitable wind down that had been telegraphed for years. Number 11. Kroger. At a glance, Kroger doesn't appear vulnerable. It's the largest supermarket operator in the United States, generating more than $148 billion in annual revenue. But in the grocery business, scale doesn't automatically equal safety. Food retail operates on extremely thin margins, and Kroger's net profit margin typically sits between 1% and 2%. When margins are that narrow, even small shocks, rising payroll expenses, a dip in customer visits, or aggressive discounting from competitors, can erase billions in earnings almost overnight. Labor remains one of the company's biggest cost pressures. Kroger employs over 400,000 people, many covered by union agreements that continue to push wages upward. At the same time, grocery price inflation has moderated, limiting the company's ability to pass higher costs on to consumers without losing volume. Theft has also escalated, particularly in metropolitan areas, siphoning off hundreds of millions of dollars annually. E-commerce presents another complication. Online grocery fulfillment is notoriously difficult to make profitable. Yet Kroger must compete aggressively with Amazon and Walmart, both of which are willing to sacrifice margins to gain market share. Kroger is fighting in that same arena while carrying significant leverage from previous acquisitions and capital investments. Total debt now approaches $20 billion. Refinancing that amount at interest rates of 6% or higher, compared to the ultra-low 3% environment of the past, puts additional strain on free cash flow. Add in softer consumer spending, reduced government SNAP benefits, and a growing number of shoppers migrating to lower-cost alternatives like Aldi and Costco, and Kroger's image as a defensive, recession-proof stock starts to weaken. In a downturn scenario for 2026, the company could find itself under far more pressure than most investors anticipate. What appears stable today could quickly turn volatile under the weight of compressed margins and rising obligations. Number 10. Walgreens. Walgreens is undergoing a gradual unraveling that hasn't fully registered with the public. The company has already announced plans to close more than 1,200 U.S. stores by 2027, one of the largest contraction efforts in modern retail. Revenue still looks substantial at around $40 billion annually, but that top-line figure conceals serious profitability challenges. Operating margins have slipped below 2%. And in multiple quarters the company has hovered dangerously close to breaking even. The pharmacy model itself is under structural strain. Insurance providers and government healthcare programs continue reducing reimbursement rates for prescriptions, while labor costs for pharmacists and technicians rise steadily each year. The squeeze between declining payouts and increasing payroll is relentless. In an effort to diversify, Walgreens invested more than $6 billion into healthcare clinics and primary care services, hoping to evolve beyond traditional retail pharmacy. Much of that expansion has underperformed, leading to sizable write-downs after failing to generate the expected returns. Meanwhile, retail theft has surged, draining well over $1 billion annually and transforming many stores from profit generators into financial liabilities. With mounting operational challenges, heavy investment losses, and shrinking margins, Walgreens is no longer the stable neighborhood pharmacy chain many remember. It's a company attempting to reinvent itself while its legacy business model steadily erodes underneath. Walgreens' financial position only deepens the strain. The company is weighed down by more than $35 billion in combined debt and long-term lease commitments. Rolling over that mountain of obligations in a 5% to 6% interest rate environment is significantly more expensive than it was just a few years ago. And the impact is showing up directly in shrinking earnings. At the store level, conditions aren't improving. Customer visits continue to decline. Sales from the front-end retail section remain sluggish. And consumers are cutting back on optional purchases like beauty products, snacks, and other convenience items that once boosted margins. Number 9. Bargain Hunt. Bargain Hunt isn't the kind of chain that collapses dramatically. There are no primetime headlines or viral social media campaigns. Instead, it disappears quietly, windows covered with clearance signs, lights turned off, doors locked for good. At its height, the closeout retailer operated more than 90 stores across parts of the Midwest and southern United States, specializing in excess inventory and overstock goods sold at steep markdowns. But that business model depends on two delicate conditions. First, major retailers must have surplus inventory they're desperate to unload. Second, shoppers need enough leftover cash to make spontaneous purchases on discounted home decor, small appliances, or novelty products. At the moment, both of those pillars are cracking. After filing for bankruptcy protection, the company moved swiftly to liquidate nearly all of its remaining stores. The reasons were straightforward: rental costs that no longer aligned with revenue, drastically reduced foot traffic, and supply chain expenses that never fully returned to pre-2020 norms. Sales reportedly plunged more than 40% in under 2 years, while operating losses climbed into the tens of millions. Even running a discount chain is no longer inexpensive. Freight expenses remain 30% to 50% above pre-pandemic benchmarks, and commercial lease rates never truly reset downward. The more decisive shift, however, has come from consumers. Lower-income households are no longer browsing for decorative items or impulse gadgets. Their limited funds are being funneled toward essentials, groceries, housing, utility bills, and debt repayments. When shoppers move from discretionary spending to pure survival mode, stores built on treasure hunt purchases disappear quickly. By 2026, Bargain Hunt won't be staging a turnaround. It will serve as an early signal of the pressures facing many smaller U.S. discount retailers. Number 8. Claire's. Claire's might appear harmless at first glance: bright pink storefronts, inexpensive jewelry, and a wave of teenage nostalgia. Financially, though, the company has been struggling for years. It already filed for bankruptcy in 2018, eliminating equity holders and restructuring billions in liabilities. That restructuring didn't represent a fresh start so much as a temporary reset. Today, the strain continues. Claire's carries more than $1.5 billion in long-term debt and lease obligations, much of it connected to malls that have experienced a 25% to 35% decline in traffic compared to pre-2020 levels. Meanwhile, its primary customers, teenagers and preteens, have shifted their shopping habits online. Platforms like TikTok Shop, Shine, Temu, and Amazon now dominate the impulse fashion space, offering lower prices and near-instant convenience that traditional mall stores struggle to match. Theft has also become a growing problem, especially in mall-based locations, quietly draining millions of dollars in inventory each year. Revenue hasn't merely plateaued, it has steadily eroded, with estimates suggesting sales remain more than 20% below pre-pandemic figures. The economics are increasingly unforgiving. Most Claire's items retail for under $10, yet rent, payroll, and security expenses have surged 30% to 50% since 2019. When your average selling price stays low but your operating costs rise sharply, the equation stops working. Without a dramatic shift in strategy or consumer behavior, the financial pressure surrounding Claire's is unlikely to ease anytime soon. At this point, even a modest dip in store traffic can tip many Claire's locations into negative cash flow. The margins are so thin that a small slowdown quickly turns profitable stores into liabilities, unless lenders agree to significant debt restructuring or management accelerates widespread closures. A true turnaround looks unlikely. What's unfolding doesn't resemble a comeback story. It feels more like a gradual wind down disguised by bright lighting, loud pop playlists, and colorful displays. Number 7. Big Lots. Big Lots once appeared positioned to survive the discount retail shakeout. Now it finds itself increasingly mentioned in bankruptcy speculation, and the shift happened quickly. Just a few years ago, the company operated more than 1,400 stores nationwide. Since then, it has announced hundreds of closures. while cash reserves have been draining at a worrying pace. The financial deterioration is hard to ignore. Revenue reached roughly $6.1 billion in 2021. But by 2024 it had slipped below $4.7 billion. Losses have expanded into the hundreds of millions of dollars. This downturn isn't solely the result of softer consumer demand. It also stems from inventory missteps, persistent markdowns, and a shopper base that is becoming more cautious with every passing quarter. Big Lots relies heavily on furniture and home decor, categories that tend to suffer first when households tighten budgets. With average credit card balances now exceeding $10,500 per household, consumers are far less inclined to purchase couches or decorative items. Spending priorities have shifted toward essentials like groceries, gasoline, rent, and utility bills. Discretionary purchases are being postponed indefinitely. Debt compounds the pressure. The company carries over $1 billion in total liabilities, and refinancing that debt at interest rates between 6% and 8% significantly squeezes free cash flow. Meanwhile, fixed costs such as rent and utilities remain elevated, and theft-related losses continue to climb. Heavy clearance promotions, meant to reduce inventory, are eroding margins that were already razor-thin. Even aggressive discounting hasn't been enough to rebalance operations. If the economy contracts in 2026, Big Lots lacks the financial resilience to weather a prolonged downturn. This doesn't look like a business executing a strategic reset. It looks increasingly like one approaching the final chapters of its retail story. Number 6. Macy's. Macy's isn't imploding overnight. Instead, it's shrinking steadily, and that slow contraction may be more dangerous than a sudden collapse. The company has announced plans to close more than 150 additional stores by 2027, adding to the 400-plus locations it has shuttered since 2015. That leaves approximately 750 stores today, a number that could continue declining as mall traffic remains on a long-term downward trend. The revenue trajectory reveals more than surface headlines suggest. In 2014, Macy's generated over $28 billion in annual sales. By 2024, revenue had slipped closer to $23 billion. And that's without accounting for inflation. Adjusted for rising prices over the past decade, the real decline in sales power is significantly steeper than it first appears. Profit margins have compressed to under 4%, leaving little buffer against shocks. Retail theft alone is estimated to cost the company roughly $1.2 billion per year. On top of that, Macy's carries more than $10 billion in long-term debt and financial obligations. Servicing that debt in a 5% to 6% interest rate environment absorbs capital that once funded store renovations, technology upgrades, and shareholder returns. Customer demographics are shifting unfavorably as well. The brand's shopper base is aging. Private label offerings no longer command the same loyalty. And fast fashion competitors operating online are undercutting prices by 30% to 60%. By 2026, Macy's may find itself facing more than a cyclical slowdown. It will likely be grappling with the continued erosion of the traditional department store model, without the financial cushion necessary to reinvent itself quickly or decisively. Number 5. Saks Global. Number 5. Saks Global. Saks Global perfectly illustrates what can happen when luxury retail collides with excessive leverage. The company emerged from the merger of Saks Fifth Avenue and Neiman Marcus, marketed as a strategic move that would create efficiency, scale, and long-term resilience. In theory, combining two iconic department store brands was supposed to strengthen their competitive position. In reality, it resulted in one of the most debt-heavy structures in the upscale retail space. Today, total debt and long-term financial commitments exceed $9 billion. That's an enormous weight to carry at a time when traffic at high-end malls remains roughly 20% to 25% below pre-2020 levels. For years, luxury spending was considered relatively recession-resistant. Wealthier households were assumed to keep shopping regardless of broader economic slowdowns. That narrative is beginning to crack. With U.S. credit card balances surpassing $1.2 trillion and mortgage payments climbing due to higher rates, even affluent consumers are becoming more selective. At the same time, Saks Global's traditional customer base is migrating online. Digital luxury platforms such as Farfetch, Net-a-Porter, and direct-to-brand websites are winning customers through faster delivery, competitive pricing, and loyalty incentives. Meanwhile, Saks remains tied to expensive flagship locations and premium mall leases, forcing it to compete against online rivals with significantly lower operating costs. Profit margins are already under strain, and the stress is visible in inventory management. Markdowns have become more frequent, and in 2024 alone the company reportedly wrote down hundreds of millions of dollars in unsold goods as demand cooled. Refinancing debt at 6% to 7% interest rates, compared to the ultra-cheap 3% era, further compresses cash flow. Instead of benefiting from scale, Saks Global appears constrained by its own capital structure, limiting its flexibility in an increasingly digital luxury market. Number 4. GameStop. By traditional retail standards, GameStop should have disappeared years ago. The meme stock surge temporarily boosted its stock price and balance sheet. But it didn't repair the core business model. It simply bought time. Since 2017, the company has closed more than 1,000 stores, shrinking its physical footprint by over 40%, with additional reductions still underway. The fundamental issue is structural and difficult to reverse. Physical video game sales have collapsed as digital downloads now account for more than 85% of game purchases in the US. That shift directly undermines the very foundation GameStop was built upon, selling discs and hardware in brick-and-mortar stores. Financial performance reflects this reality. Revenue peaked at approximately $9.2 billion in 2012. By 2024, sales hovered just above $5 billion. Even after aggressive expense reductions, efforts to reinvent the company, through ventures into NFTs, online electronics, and collectibles, consumed hundreds of millions of dollars while generating minimal sustainable returns. Operating profits remain weak, comparable store sales continue declining, and customer traffic shows little sign of recovery. Yes, GameStop currently holds roughly $1 billion in cash reserves. But cash alone does not equal transformation. Without a compelling long-term strategy, that reserve may simply fund ongoing operating losses rather than fuel meaningful innovation. By 2026, a dramatic bankruptcy filing may not even be necessary. Instead, the brand could gradually contract, location by location, until it becomes another symbol of the fading mall era. Number 3. Rite Aid. Rite Aid has already crossed a threshold that few retailers recover from. It has filed for Chapter 11 bankruptcy protection, closed hundreds of stores, and is now being dismantled in stages. At its peak, the pharmacy chain operated more than 4,600 locations across the United States. What remains today is a significantly diminished network struggling to redefine its role in a rapidly changing healthcare and retail landscape. Today, Rite Aid operates fewer than 1,700 stores, and that number is still falling quickly as additional closures are announced. The financial collapse behind that contraction has been dramatic. Prior to seeking bankruptcy protection, the company was burdened with more than $8 billion in debt. Annual revenue had already slipped below $24 billion, down from over $26 billion only a few years earlier. Losses mounted into the hundreds of millions, stripping away nearly all financial flexibility and leaving management with few viable options. The decisive blow came from opioid-related litigation. Settlement costs and legal liabilities drained billions of dollars, wiping out any realistic path to stabilization. But even without the lawsuits, the foundation of the business was cracking. Pharmacy reimbursement rates from insurers and government programs continued to trend lower, squeezing margins tighter each year. Meanwhile, wages for pharmacists and support staff keep rising, reflecting broader labor pressures in healthcare. Add in escalating theft, higher security spending, and growing regulatory compliance costs, and thousands of locations were pushed into negative cash flow. Rite Aid is no longer attempting a turnaround. What's happening now resembles a controlled dismantling unfolding in public view. By 2026, whatever remains of the chain will likely be sold in segments or quietly absorbed by competitors. This isn't simply another retailer downsizing. It represents the near-total disappearance of a once dominant national pharmacy brand. Number 2. JOANN. JOANN's trajectory offers a clear example of how a specialized retailer can be squeezed from every angle simultaneously: debt pressure, digital competition, and collapsing discretionary spending. The fabric and crafts chain filed for Chapter 11 bankruptcy in 2024 while carrying more than $1.6 billion in total liabilities. That filing wasn't part of an ambitious reinvention strategy. It was an emergency measure to avoid immediate failure. Since then, the company has been retreating. Hundreds of stores have been shuttered. Inventory levels have been slashed. And executives have openly acknowledged substantial doubt about the company's ability to continue operating as a going concern. The revenue trend underscores the challenge. In 2019, JOANN generated more than $2.7 billion in annual sales. By 2024, revenue had fallen closer to $2.1 billion. Once adjusted for inflation, the real decline is even steeper. Costs, however, have not followed the same downward path. Freight expenses remain 30% to 50% higher than pre-2020 levels. Labor costs have risen at double-digit rates. And theft-related losses have increased across suburban strip mall locations. Nearly every major expense category is moving upward at the same time revenue is sliding. The customer base is also under strain. Hobbyists and do-it-yourself crafters tend to cut back quickly when household budgets tighten. When paychecks are absorbed by rent, groceries, and utilities, spending on fabric, yarn, and craft supplies becomes optional. Even after restructuring, JOANN still carries more than $900 million in long-term debt. Refinancing that balance at interest rates between 6% and 8% accelerates cash burn as 2026 approaches. This does not resemble a recovery in progress. It looks more like a drawn-out liquidation timeline, one that retail watchers have seen before. Number 1. Forever 21. Forever 21 isn't experiencing a temporary slump. It has been steadily unraveling for over a decade. The fast fashion retailer filed for bankruptcy in 2019, closed more than 800 stores globally, and re-emerged as a much smaller and far more vulnerable operation. Today, its U.S. footprint has shrunk to roughly 400 locations, and that number continues to decline as leases expire and losses persist. The revenue drop tells a stark story. At its peak, Forever 21 generated more than $4.4 billion annually. By 2024, U.S. sales were estimated between $1.60 and $2 billion. Adjusted for inflation, the contraction is even more severe. But falling sales are only part of the issue. The competitive landscape has fundamentally changed. Ultra-low-cost online brands like Shein, Temu, and similar platforms now offer comparable styles at prices 30% to 60% lower, often with faster shipping and virtually endless selection. Forever 21 cannot match those prices while still covering mall rent, utilities, payroll, and in-store security expenses tied to physical locations. Its financial position compounds the challenge. The company remains weighed down by hundreds of millions of dollars in lease commitments and supplier payables. Inventory markdowns are constant, used as a tool to keep merchandise moving in the face of weakening demand. Theft-related losses continue to rise. And U.S. mall traffic remains 25% to 35% below pre-2020 levels. By 2026, this likely won't be framed as another comeback attempt. Forever 21 appears to be edging toward a second bankruptcy. This time, there may be no revival narrative, just liquidation signs, shuttered storefronts, and the quiet disappearance of what was once a dominant force in fast fashion.